Welcome to the Farms.com Risk Management Market School video series. This video series is being brought to you and sponsored by DeKalb Brand Seeds to educate producers across Canada on how to do a better job of that grain commodity marketing. You can find us at www.marketschool.farms.com. In this 25th video, we're going to look at the 15 rules to grain marketing. We have put together some rules to grain marketing. It's trying to provide a little bit more discipline for that farmer, less emotion. In this video, we're going to try to remind farmers to make more disciplined and avoid using less emotion when it comes to grain marketing. As I always like to say, that marketing is more of an art than a science, so use discretion when applying them. There's no particular order to these rules, so let's start off with the rules to grain marketing. There's the 7 stages to marketing. We seem to go from I don't know, confused, happy, get to those seasonal highs, you're exuberant, hallelujah, we got record highs, yet you do nothing. Then you get into hopefully they'll come back, angry, embarrassed, exhausted, don't know what to do again. So let's try to avoid the second half of that emotional cycle. We need to be part of that uprising first half of that cycle. So let's look at our rule number 1. Avoid selling when prices are in the bottom quartile. It does not pay to panic. Always love to say that. It does not pay to panic. You have to give markets time. Patience is a virtue. Here's an example for rule number 1. This is the 2011 December corn weekly futures chart that goes all the way back to 2008. And basically I've circled there at the bottom. Don't panic, don't sell in the bottom quartile of prices, be patient. Rule number 2, when prices are high, become less emotional and choose to be a price taker. Do not fall in that miss the boat syndrome. Example for rule number 2, this is the 2011 November soybean weekly futures chart. And you can see, but going back to 2008, you had a couple opportunities to sell at record highs, top 25% of prices. It's time to sell some bushels at those highs. Become less emotional. Don't ask how much higher prices will go, but perhaps how much lower will they go. Rule number 3, do not ask again, what if prices how much higher may prices go, but what is my risk versus reward? What if prices go much, much lower? At a minimum, protect the fall-winter months because supplies tend to overwhelm demand during that particular period. Example for number 3, rule number 3, 2008 November canola daily futures chart. You can see the highs there through the spring, summer, and then the lows to the fall-winter. So at a minimum, protect that. What's the strategy to protect those record high prices? Rule number 4, set goals. Know your cost of production. Develop a marketing plan. Set your strategy, instruments to use, and execute. Pull the trigger. Don't forget to pull the trigger. Here's an example for rule number 4. This is the 2011 July Minneapolis wheat daily futures chart, and you can see through that late spring, had some highs there in that 1050 plus a bushel. There's nothing wrong with these prices. You can see shortly after that the market did finally collapse there temporarily. So don't forget to pull the trigger. Rule number 5, adapt your marketing plan as the market unfolds. Protect prices with a floor using futures and options. Example for rule number 5, 2011 November canola daily futures chart. Near those seasonal highs, you could have protected by selling forward some bushels, selling futures, or buying put options. Rule number 6, speculators are your friends, not your enemies. Take advantage of friends when prices are at historical highs. They can make money going up and down. You cannot. You only make money when prices are going up. If the prices start to fall, you start to lose money. Example for rule number 6, this is the 2011 gone into some livestock charts here, but as an example, April live cattle futures chart for 2011, you can see that your enemies, which I call friends, those speculators, were just driving cattle prices higher and higher. At those seasonal highs, you needed to sell some cattle. Rule number 7, have some idea of the seasonality in your business. There's that seasonal corn chart. The next one is an example. Rule number 7, using soybeans. There's a seasonal chart that looks exactly like the corn chart. You tend to bottom on October 1st every 5, 10, 15, 30 years. We've done a video series on seasonality. Go back and look at that. Go back to marketschool.farms.com and you can also get to know a little bit more about seasonality. Rule number 8, 8, risk management is not becoming an expert in speculating, making money in futures and options on Chicago or the ICE exchange, intercontinental commodity exchange. Learn to use these tools to manage the risk and the volatility in your business. Example rule number 8, 2011, July Chicago wheat daily futures chart. Again, through the late spring, March, April of this year. Could have sold some Chicago wheat in that 950 area. Very good price for Chicago wheat. Manage that risk, manage that volatility. Rule number 9, objective each year is to make profits, grow your long-term equity, and obtain a top quartile of prices each year. Example for rule number 9, 2011, July, Kansas City, Minneapolis wheat futures. You can see again through that late March, April, achieve that $10 range for Kansas City wheat, which is a very good price. Again, selling in that top quartile of prices in any given year. Rule number 10, determine your risk tolerance. How much debt do you have? How far can you delay selling? Receiving cash if you need to. The larger folks that have been around for a while tend to have a little bit more capital, can probably let profits ride. The younger farmers that have a little bit more debt may have to, pull the trigger a little bit earlier. Example for rule number 10, 2011 December corn daily futures chart. Ask not how much higher, but rather how much lower can we go, particularly when you're at seasonal highs. This one's a late seasonal high. Rule number 11, if you hope for higher prices, use options, a limited risk to chase prices. You can always buy the grain or bushels back on paper. Example for rule number 11, 2010 November canola futures chart. You can sell canola bushels forward and then go long futures or call options. This is the 2010, at the very bottom. You could have sold some bushels forward at a considerably lower price than where it ended up when this contract was finally over, but you could have made money by going long futures or call options. Rule number 12, determine the role of third parties, brokers and lenders, finance people in implementing the strategy. Have them understand that you're a hedger. You're long in commodity, you want to protect that price. You want to hedge against an adverse price movement. Both of those parties can help you manage that risk if they understand what you're trying to do. Explain the marketing plan, the business plan, the risk management plan. Rule number 13, Boone Pickens, the famous U.S. oil tycoon, says a fool with a plan will always beat a genius with no plan. And I honestly believe that. Have a plan, but make sure you execute and pull the trigger as well. Rule number 14, at a minimum, protect the fall winter months as supplies tend to overwhelm demand in most years. This is an example, rule number 14. This is the 2011 December oat daily futures chart, trying to give you an example of all the grains here that trade on the ICE exchange or the Chicago Mercantile Exchange. And you can see you could have sold near those seasonal highs in the $4 a bushel, and shortly after the market did finally fall apart. Rule number 15, the last rule, luck shouldn't be part of any business or risk management marketing plan. You may get lucky 1 in 10 years. There's always an exception to the rule. Example of rule number 15, 2011 December corn daily futures chart. That's very rare, where corn prices are hitting record highs in the month, late August or month of September. So, in summary, sticking and executing to your marketing plan is critical, and having these rules can remind you of what needs to be done when emotion gets the better part of you. Stay focused, be disciplined, use less emotion, and you too can be very successful at marketing. Marketing can be easy and fun if one sticks to the set goals, and trading at specified periods established after careful research. In our next video series, we're going to look at dealing with a futures commodity broker. Till next time, thanks for watching. Hope we've provided you with some insight and inspired you on our topic, the 15 rules to grain marketing. We look forward to seeing you next time. Take care.